And this session is particularly interesting because obviously it's about second charge mortgages, but importantly the impacts that MCD has on them, and of course how they can be a useful tool in your day-to-day business as well. So hopefully you'll find something useful to take out of it, and this is the place to be for your essential guide to second charge mortgages. So by now, one would have thought that you've probably, hopefully, heard about the Mortgage Credit Directive that kicks in next March. And are most of you here first charge residential in that market space, yeah? So the great news for you is that actually you probably won't notice a lot of change because you're already in a regulated marketplace, and one of the biggest changes for second charges is that become regulated mortgage contracts. So for those of you that are already in that marketplace and already dealing with regulated loans on a day-to-day basis, for a change, you've actually one of the least impacted. So that's good news for you for sure. The great news is because of the fact that second charge mortgages are then become regulated mortgage contracts, there's a few benefits for you and for your customers, because of course there's greater levels of consumer protection. In addition to that, the whole second charge product in general just becomes a bit more popular. People begin to know about it more, and that's because there are some key things that come out of the Mortgage Credit Directive, and I'm just going to talk you through some of them as well. So first and foremost, second charge mortgages become regulated mortgage contracts. The Credit Directive actually applies equally to first and second charge mortgages. So apart from the actual legal ranking that a second charge sits behind a first charge lender, there's no other difference. There's no other difference in terms of the initial disclosure that you have to do, in terms of the fact find that you'll probably have to carry out, sourcing, etc., etc. So everything aligns entirely, and so rather than actually not being sure at the moment what the process is for second charge mortgages, it's exactly the same as it will be for a first charge mortgage. So it just basically gives you some more options because of the fact that it's just another product to actually add to your list of solutions for your clients as well. So as part of that, there are different disclosure obligations that happen as part of the Mortgage Credit Directive, and basically when your clients are looking to raise some additional capital, it basically just means that you need to disclose that there are alternative finance solutions available. So where they're looking to raise some money, you need to say, look, I might look at a remortgage for you, but in addition to that, it might be appropriate to look at a further advance, and a second charge mortgage now is something that must be disclosed as part of that initial disclosure. So that's great because it actually gives you a platform to start discussing things with your client. And actually, our academies, we're running them here, but we run them throughout the country as well, just because of the fact that as part of disclosing that and as part of talking about second charges more regularly, of course, it's good to brush up on product knowledge and be aware of where they can actually help your customers as well. And that leads into the adequate explanation as well, because the only way that you can really give a proper adequate explanation of the features and the benefits to your client is, of course, if you're knowledgeable on the subject. And there's some help with that as well, because as part of the sales process that aligns, actually, you've got sourcing systems out there now. There's one in particular that's already out there. There's definitely others that are being built to help support that. So the great news is that by the time the Credit Directive actually kicks in, you're going to have the same access to information that you do for the first charge lenders as well. So it's going to be much easier to be able to compare and contrast and decide whether or not that's going to be a suitable solution for your client. So everything aligns, and you're all regulated to do first charge mortgages, therefore you're already in the advising and selling standards bracket, that's fine. But just so you know, the second charge brokers that are already out there, they also need to be adequately qualified up to level 3 like you guys are just now. So that's what's coming as part of the Mortgage Credit Directive. Those are some of the changes in the marketplace. But is there an actual marketplace for it? Is it a place that you want it to get into? Well, once upon a time, the secured loan market was worth £7 billion. So it was a huge marketplace, a very different one to now. So just to put that into some perspective, last year in 2014, the second charge mortgage market was worth about 600 million. So a bit of a change there. But what I would say is, and it's a growing market, because in March this year, this was the last time I updated the figures, but it was 75.5 million that not Shawbrook, but as a sector we wrote in 1 month. And actually that's quite important, because if that's the run rate going forward, then that's close to £1 billion market. So the fact is we're at 600 million now, but we're quite proud of that, because actually when you consider the journey that secured loans have taken over the past few years or so, since 2007, it's been quite a harsh one really. And I was just going to sort of remind you of that, just to put that into perspective as well. So back in 2007, like we say, it's a great marketplace, it's all booming, it's a £7 billion £1 market. You can write them day in, day out. But one of the key things there, it was a symptomatic of a very different sort of type of marketplace at that point. Because actually, yes, we were writing lots in secured loan business, but it was one of those marketplaces when the FCA did some research, and it was in their consultation paper that they released last year. And actually 1 in 2 secured loans fell into arrears at that point, so over half. And in addition to that, a third of those loans actually fell into arrears within the first 12 months of lending. So that begs the question then, was that really the right thing for the customer? Because actually, if they were falling into arrears at all, and as quick as within the first 12 months, then there's a big question mark over whether or not it was the right marketplace. So the great thing is the 600 million market that we're in now is much more sustainable, because back then, lenders didn't have to do affordability checks, they didn't have to stress test, it wasn't regulated by the FCA, and those are all things that are applicable now and are we're currently in that marketplace, and there's only more protection for the consumer to come. So bear in mind it was a very different place. Of course, those were unsustainable practices, so by the time you reach 2008 there's a credit crisis. Of course, it can't cope with that because they were unsustainable practices. Lenders closed down, as did first charge lenders as well, and actually the FLA reported that the market closed dropped by about 84% overall. And in December 2010, it bottomed out really. In that month alone, only £16 million worth of business was written. So, Shawbrook entered the marketplace in 2011. Now, as you can see, things started to pick up after that. So it's, but actually, I say that tongue in cheek because, of course, things will pick up. Then the market dropped to as little as 16 million in 1 month. It wasn't because the consumer no longer required second charge mortgages, of course. It was because of the fact that there weren't enough lenders around to finance that market. So, of course, as you get more lenders that enter into the market, you start to see it grow. And of course, we were at about 600 million for last year. 3 new lenders entered into the marketplace, and this year it will be closer to 1 billion. We don't know exactly what we're going to finish up on. So clearly it's a growing marketplace. There is potential there, and with MCD that kicks in next year and everything aligning, there's even more potential still. In relation to the remortgage market, which of course the second charge is born out of a customer looking to refinance and raise some capital, 600 million doesn't necessarily seem a huge amount. But actually the most important thing that I want to point out about this 600 million figure is that most of that came from aggregator sites. So what that means to you is that that's your clients that you've been talking to in some capacity or another who have found their way onto Google and actually then took out a second charge loan through going out on a search engine. Okay, so actually what we hope the Mortgage Credit Directive will also bring is the confidence for you to start discussing those with your clients, because there's currently a marketplace that's growing, and if you're not in it, your clients still are, and their clients are still borrowing. So if you're not familiar with the products or the scenarios or the opportunities out there, then of course they're going to find their way to second charges elsewhere as well. So as we stand at the moment, we are a regulated market by the FCA. The contracts themselves are not regulated. That kicks in next year when the Mortgage Credit Directive kicks in. So I've told you about that. You know where we stand. You know what's coming. But actually, you might say to me, well, the thing is, Claire, I just haven't really done anything because I'm not in that marketplace. Nobody ever asks me for second charge mortgages. I only deal with high net worth clients. This was this time last year we asked these questions. Why are you not writing secured loan business? We just wanted to know. And those were some of the answers that we got. So we also asked then, okay, well, what is it that you're finding difficult to place? First charge, residential properties, what is it that's difficult at the moment? And in a survey that we conducted just recently, these were the answers that brokers were giving us. So lending into retirement, adverse credit, clients that have got interest-only mortgages, these were all the things that you were finding most difficult. So some of you may agree with that or disagree, but those were the results that came back on the survey. But what was most interesting from our point of view is actually it's quite clear that the cases that you're finding most difficult to place are actually some of the most common reasons that we lend on a second charge basis, and I'm going to explain why. So if we take the first half of that, lending into retirement, as standard, our lending criteria, will easily go up to age 80. We're one of the most flexible lenders in the marketplace, so if you come to us with a deal that makes sense as well, we can look to do exceptions provided the case stacks up, and of course there's a good outcome for the customer there as well. In terms of flexible terms, I don't mean to, teach you to suck eggs, but actually when I was talking to people, a lot of brokers didn't realise that you could take out a second charge for either a longer or shorter term than the existing first charge mortgage. So great, if you've got a customer that's actually maybe only got 5 or 6 years left on their mortgage, they're approaching retirement, and perhaps they need to borrow some more money because they want to do home improvements or want to pay for a daughter's wedding or something like that, and it might be appropriate to take that over a 10-year term. Okay, that's fine. It doesn't matter that the first charge mortgage has only got 5 years remaining, no problem. Equally, if they're debt consolidating and maybe they just want to, they don't want to drag out the interest payments over a 25-year period, then equally it might be appropriate to take that over a 10 or a 15-year term so that they pay less in interest overall. So we can happily do flexible terms on that basis. We'll accept accountant certificates, so if you've got customers that have got complex income streams or income from various different areas, we've got no issue with an accountant detailing everything, and we can accept all of that. Equally, if someone has only been self-employed for 6 months, no problem. We can work off projections as well, which isn't that commonplace in the first charge mortgage market. So those are just some of the reasons that we can actually, so now you can start to say, well, okay, I do have those types of customers, but maybe you didn't realise that actually sometimes a second charge might be the solution for those type of customers. Equally with adverse credit, we can look at clients. It's quite common for lenders now to accept customers where maybe they've missed a payment or they've got a default or a CCJ or something like that. But we can be used for an exit for customers who are looking to redeem an IVA or a debt management plan. And if they do have some bigger CCJs or defaults, we've got products to accommodate all of that kind of stuff as well. But the perception in the marketplace used to be that it's only for those type of customers, but not at all. When you consider that people that have lifetime trackers, maybe I spoke to a broker the other day there, and actually it was the 1.84 the client was on. They only wanted to raise £9,000 just for some new windows. There was no point in remortgaging them off of that, because at 95% loan to value, which is what they were looking for, the rates were up at about 5%. So there was absolutely no reason, and clearly a second charge would be the sort of perfect solution in that type of scenario. So remember, if your clients are on lifetime trackers, you'll be perhaps doing a lot of fixed rate, long-term fixed rates these days. 5 years tend to be quite popular. Now that's all very well, but that doesn't mean that within the next 5 years those clients won't need to raise money for some additional purpose that's unforeseen at the moment. So bear in mind, in those scenarios, a second charge might be appropriate. Some customers are just genuinely trapped. MMR kicked in a couple of years ago, 2014, and some customers are just genuinely trapped and can't really move anywhere, but still have a needs to capital raise. Debt consolidation, business purposes, tax bills, will lend for all of these reasons without any issue at all. And some things that, we go right up to 95% loan to value. So this isn't a particular product push from Shawbrook as such, but it's just to give you an idea as to the levels and the loan to values that we can go to. 95%, not a lot of people realise that we can go as high. And, the most frequently asked question after that is, but will the first charge lender consent? Well, 100%. They do often. So there's various different reasons that you might consider a second charge. We've touched on some of them, but actually some of the main things that I just want you to take away, remember that the market's already regulated by the FCA, so it gives them a bit more credibility almost, and customers a bit more peace of mind that potentially actually the different solutions that you're looking for are going to be the right thing. So they've got greater consumer protection in there. The sales process, remember, is aligning with the first charge market. So for you, a second charge mortgage just becomes another product out there. It doesn't need to be something that's specialist that you don't really deal with, because clearly with the profiles that we've mentioned, there will be clients within your client bank that do qualify as such for second charge lending. So everything's verified. We mentioned the arrears rate and things like that. Clearly that's dropped an awful lot because now we stress test, we do all these income and expenditure checks. But what we can do is take a lot more income than some of the lenders in the first charge arena can take in, because we'll take 100% of things like bonuses, foster income, additional income like that is all standards that we take 100% of in the second charge marketplace. So it is a flexible option. It's a genuine alternative to a remortgage. The Academy today was just to give you a bit of a snapshot as to why it is that second charges are where they're changing within the marketplace, and why it is that you do definitely have those types of clients, even although sometimes the perception might be that you don't. So if you do have any questions, that's the end of the presentation. We've got our stand over there. We've still got some pastries left. I think we've got some Prosecco coming not too long after that. But if you have any questions, come and chat to us, and thanks very much for your time. Cheers.